Good day, and welcome to the Alston and Bird's weekly webinar series, Making the Most of Tax Reform. Today's session is Anti-Hybrid Rules. Today's conference is being recorded. At this time, I would like to turn the conference over to Scott Harty. Please go ahead, sir.
Thank you. Good morning, everyone, and thanks again for joining us. My name is Scott Harty. I'm a partner in the Federal and International Tax Group here with Alston and Bird, and I'm joined again by my partner, Sam Kaywood. This week, Sam's going to walk us through some issues in the new anti-hybrid rules under Section 267 Cap A and 245 Cap A. And we've got a pretty comprehensive set of slides. Although Sam's not going to be able to go through all of them, hopefully they will be helpful to you so you can have that as a takeaway. Once again, all the prior presentations are available on the website, so you can listen to prior recordings as well as download materials from the prior presentations. Also, just to reiterate, we are expanding the series, so in the next few weeks we're going to turn to some other topics. We'll address opportunity zones, some state and local tax issues, and then look at some benefit-related issues. So hope you can join us for those, and stay tuned. We'll send out updates on those topics and the scheduling. Also, during the call, we always welcome questions. So if you have a question that you'd like to raise, please feel free to submit it anytime during the call or anytime after the call if you have a question afterwards that you'd like to raise. We probably aren't going to be able to answer questions during this call given the magnitude of the material, but we will get back to you and get a response to you. So given the limited time and the amount of material, let's go ahead and get started. Sam probably needs no introduction, but just for those who may not know, Sam concentrates his practice on federal income and international tax matters, including cross-border M&A and joint ventures, as well as inbound investments. And he has a substantial experience in Canada, Europe, China, and Latin America, and is a frequent speaker and author on international tax topics. So Sam, I just want to thank you again for joining us, and with that, I'll turn it over to you.
Okay, thank you, Scott. So this program, just 30 minutes to summarize the anti-hybrid rules that came out in early December, proposed regulations. They haven't been finalized yet, but they're a pretty thorough guide to some of the things that we need to be paying attention, in some cases sooner rather than later. This was we're only going to cover sort of a fraction of the slides in this deck, but this was a presentation that me and a few others gave to the Practicing Law Institute in January, and it's a comprehensive deck it covers many, if not all, of the examples in the proposed regulations, both sets of proposed regulations. So this is designed to be sort of a study tool for anyone who really wants to wrap their mind around it. So let's start with the inbound anti-hybrid rules. And I'm going to fast forward all the way up to, let's see here. Okay. So let me start with the takeaway. So the first part of this discussion will be about the inbound side of things. If you're a company, a U.S. company that's owned by, a foreign group or foreign shareholders, and there's any type of tax arbitrage somewhere in the structure, this is really the takeaway. If there is a deduction in the U.S., if the U.S. company is paying interest or royalties or something that's deductible in the U.S., or that would be deductible in the U.S., and that deduction is somehow traceable to tax arbitrage, meaning that the income side of that is sheltered in some form or fashion, directly or indirectly, these rules are trying to smoke that out and to disallow that deduction. So the starting point of the regs is something called the disqualified hybrid amount. This is a payment to a foreign party that would be deductible generally. Again, it could be interest, royalties, could be something else. Any deductible payment that is sheltered in the foreign jurisdiction. So let's go over to let's go straight to the charts. Okay, so here is a basic hybrid instrument. This is an instrument that is debt for U.S. tax purposes, but equity or stock for foreign purposes. There are a number of ways to do this. One of the ways is covered in this deck, the sale repo arrangements. Won't talk about those in detail, but just one of many ways of having a loan that is treated as a loan for U.S. tax purposes, but as something other than a loan. If it's stock for foreign purposes, in many cases, the foreign country would give an exemption on what they think to be dividends. What we see to be interest as deductible, they see to be a dividend, and they don't tax dividends, and consequently, the income is not taxed in the foreign country. Well, that's what these rules are designed to get at. So the interest in this example, interest paid to FX on this hybrid loan would be non-deductible. Okay, on this slide, the idea here is that the no inclusions, so there's a deduction, the payment of interest. There has to be a no inclusion on the other side, meaning that the income isn't taxed in the hands of the recipient. That no inclusion must result from hybridity, meaning that, let's say in country X, where FX is organized, they simply don't tax interest income. And so the instrument might be a hybrid instrument, but the no inclusion in the foreign country arises from another rule. It doesn't arise because of hybridity. That's not that interest is not going to be disallowed. That's not a hybrid deduction payment. So that okay. This is a bit of a trap. Here we have a hybrid loan, and we have a company, FZ, that is transparent in country X. So we have a payment of interest to FZ, which could also be included in income in FX. And the income must be taxed in both countries. Otherwise, it's a non-deductible amounts, so that even though there's a payment to, let's say there's a payment of hybrid interest to FC that's taxed in FC, if FC is transparent and owned by FX in this case, and FX does not include that in income, then the payment is non-deductible. You see a comment down at the bottom of the slide. This doesn't strike us as being right, to say that the item must be included in income in both countries at the same time. In the preamble to the regs, the Treasury looked at a possible exception. They rejected it. As I mentioned last week, I'm part of a group at the ABA tax section putting together comments, and this is one of the items we're gonna put on the list because it doesn't seem quite right. So these are the repo transactions that are specifically called out in the examples. I won't talk about those. Okay, disregarded payments. So here's an example. We have FX, which owns US1. US1 is a corporation for U.S. tax purposes, but is disregarded for foreign purposes. This can arise, for example, from a general partnership. Maybe we have a 1% partner in the FX group somewhere. So for foreign purposes, there's a partnership. For U.S. purposes, the entity checks the box to be treated as a domestic corporation, so that when US1 pays interest back to FX, that's interest for U.S. tax purposes. It's a regarded payment, but FX itself does not include the interest income because US1 is a partnership and therefore disregarded or transparent for foreign purposes. And so these types of payments are now clawed in as non-deductible hybrid payments. Okay. Let's see. I got myself lost. Okay, hold on. Okay, so here is an example. Excuse me for that. Here's an example where we have a fiscal unity or a consolidation regime. So we have FX1 and FX2 that are consolidated for foreign tax purposes. FX2 has a U.S. branch. FX2 pays interest to FX1 and allocates some of that interest to the U.S. branch. Under our ECI rules or 882-5, some of that interest would normally be allocated against U.S. income, therefore reducing the U.S. tax base on the branch. Because that interest payment is disregarded for foreign purposes or eliminated in the consolidation, that's going to be a hybrid amount that will be disallowed. So the portion that's allocable to the branch would be disallowed. Here's another example involving deemed royalty payments. So under our treaties, we treat a U.S. branch as a separate entity, and we, in the case of IP, we can actually impute a royalty payment to the foreign home office, and if that royalty payment is disregarded for foreign tax purposes, that will be a disallowed interest payment for our purposes. Okay, branch mismatch payments. This was a popular structure involving Luxembourg in most cases. It could be FZ, could be a Luxembourg company, and the BB, the branch in country B, that could actually be the U.S. And so US 1 pays a royalty to this U.S. branch of a Lux company. And what we were doing here is to say that, okay, well, the U.S. branch is not sufficient to actually be taxable in the U.S., but on the other hand, the Luxembourg entity would treat that as associated with a foreign branch. And so Luxembourg wouldn't tax the income as well. The U.S. didn't like this. There was an agreement between Luxembourg and the U.S. to attack these arrangements, although that agreement is of questionable validity. But nevertheless, the idea of arbitraging with branches, making a payment, a deductible payment to a branch that's not taxed in the branch country and also not taxed in the home office country, that's now being attacked here, and the payment is non-deductible. Okay, this slide is an interesting one because so far you might be saying, well, wait a minute, I'm not owned by a foreign parent. I'm a U.S. multinational, so why do I care about these rules? Here's an example 7 in the proposed regulations that would apply the rules to CFCs, to payments between CFCs. Here's a hybrid loan from one CFC to another, and a payment of hybrid interest, which under our rules we would normally ignore them or treat them as exempt under 954C6, and the regs are saying that to the extent that the interest payment received by FX is not included in tested income, then this anti-hybrid rule would apply, and there's you disallow a deduction at the level of FZ, the paying CFC. This doesn't really make much sense to us. The group of us that are working on these comments, we think that these 267A anti-hybrid rules should not apply to CFCs. We think the idea behind the statute and the regs was to prevent U.S. arbitrage, reduction of the U.S. tax base by payments that are arbitraged in a foreign country. So this will be included in our comments. We think this would make it extraordinarily difficult for U.S. multinationals to have to worry about this. Okay. Okay. Just a quick few minutes on imported mismatches. So here's a situation where we have a U.S. payer, and it has borrowed money not under a hybrid loan, but under a plain vanilla loan, but yet that the payee, in this case the imported mismatch payee, a foreign entity, it is sheltering that interest income with some sort of hybrid arrangement. So the hybrid arrangement doesn't take place between the U.S. party. It takes place between two foreign parties, but the effect of that hybrid arrangement is imported into the U.S. by virtue of sheltering the interest income that the U.S. Company is paying to the foreign payee. And so this basically takes us a step further into the structure, into the foreign structure, to figure out, well, gee, where is that interest going, and is it being sheltered? And if it is through some sort of a hybrid arrangement, or really any arrangement mentioned in these regulations, then the U.S. interest will be disallowed. So I want to skip forward to example 9, the funding rule. Now, again, a plain vanilla loan between US 1 and FC, foreign owner. FC owes interest to a branch, and we just talked a little while ago about the branch rules and how if somebody's not paying tax on income associated with a branch, that was a bad thing, and we're going to disallow the deduction. So here, the U.S. interest deduction on a plain vanilla loan is traceable to an arbitrage that occurs with respect to this branch. So here we are now 2 steps removed from the U.S., and we have to determine, well, gee, is that payment of interest to FZ, which looks and breathes just like any other normal interest payment, is that payment somehow directly or indirectly traceable to arbitrage that is occurring in the structure? And this is one of the, I think, really challenging points in these regulations, is that a U.S. subsidiary in a foreign group is going to have to satisfy their financial auditors, who can be quite intrusive sometimes, that there isn't any of this arbitrage going on. So we're going to need to see the entire structure. We're going to need to see the flow of payments to persuade our financial auditors that we're not running afoul of these regs. This is a point we're including in our comments, that hey, this is quite unwieldy and seemingly too much. Okay, so with that, we've got 10-12 minutes left. Let's move over to the outbound anti-hybrid rules. And here I'd like to start with a basic rule, which is what this is all about. Well, it's about more than this, but a starting point is the 245, the new 245 Cap A dividends received deduction. So the tax reform bill introduced a dividends received deduction for income from foreign entities. Now, the amount of this DRD, it's great. It's designed to be a territorial system to that extent. The amount of this DRD in this year, next year, the years after, may be somewhat limited, because most foreign income, a lot of it was taxed under the one-time tax under Section 965. So that income that has been taxed under Section 965, the one-time tax, that's going to come back as previously taxed income, so that when it's distributed, it won't be taxed at all, and it's not subject to a DRD, because it is tax-free PTI, what we call PTI, previously taxed income. And and a lot of new income after the effective date of that one-time tax. A lot of new income will be GILTI, as we talked about last week, and thus it will be distributed or can be distributed as PTI. So this DRD and this anti-hybrid rule under the DRD rules will not apply to this high amount of PTI that a lot of U.S. multinationals have in their CFCs. So that's the good news. But the DRD itself was designed, again, to provide this exemption on a dividend. So let's say, we've made new money that's not GILTI income, and that income can come out subject to this DRD, and that's dividends received deduction. That's a great thing. But there's an anti-hybrid rule built into this DRD, so that if a dividend that would be subject to the DRD is subject to this anti-hybrid rule, then the DRD is turned off. And so not only do you lose the dividends received deduction, but you also lose any foreign tax credits associated with that dividend. So what is the anti-hybrid rule? In most cases, it's going to apply to hybrid instruments. So here we have U.S. that owns FX. Let's think of FX as being a Luxembourg entity. We were able to create a hybrid arrangement with what we called PECs and CPECs, preferred equity certificates and convertible preferred equity certificates. And these instruments were generally considered equity for U.S. tax purposes and debt for Luxembourg tax purposes. And generally, there was no interest for Luxembourg actually paid. It was all accrued because in the old days we were trying to avoid dividends in the U.S. We wanted deferral. So you have these large accruals of what is interest for Luxembourg purposes, but what is would be dividends if paid, but they just aren't ever paid or weren't ever paid. So these amounts now are for new amounts accruing after the effective date of tax reform. These amounts are going to go into a hybrid deduction account, so we now have to track the deductions that are allowed in Luxembourg. We will add to this hybrid deduction account as and when we accrued these benefits in the foreign country. And then when there's a dividend of this HDA, then the dividends received deduction and the foreign tax credit are denied. So this is a new accounting that we have to do, and this will be part of our diligence when we acquire a U.S. company with CFCs. We'll now have to ask ourselves, okay, is there any of this HDA account that we need to know about so that we avoid having a dividend from this company? So let's just sort of move on a little bit. Okay. Okay, let me just go back one. Okay, so one of the bullet points here, hybrid dividends between CFCs are treated as Subpart F income. So this is an important one. If there is a dividend from one CFC to another, normally that is exempt from Subpart F under 954C6. However, if we have some of this hybrid deduction account, this HDA, attributable to the paying CFC, then then this dividend would be deemed automatically to be Subpart F income, and that Subpart F income also would not give rise to foreign tax credits. So this is a particularly tough rule. Now, in the last few minutes, I'd like to focus on the impact and what should we be doing about this? Well, the PECs and CPECs, hybrid instruments, and things like it in other countries, instruments like it in other countries. In most of the European countries, this is being phased out by the end of 2019. There was the Anti-Tax Avoidance Directive 2 in EU that basically requires each of the EU countries to implement legislation that would eliminate these deductions, and so these deductions for foreign purposes would no longer be allowable. Most clients have been thinking about eliminating their hybrid instruments in their CFCs by the end of 2019. But we urge our clients to eliminate them as soon as possible so that we can minimize the amount of this HDA account that has to be added to as deductions are allowed for foreign purposes. Now, because that HDA is a bit of a time bomb that it's sitting there, and we don't know when it will go off, but it will go off when there is a dividend from either one CFC to another or from a CFC to the U.S. parent, and that dividend is now going to be taxed without any foreign tax credit shelter. So we think that it's best to eliminate these arrangements relatively soon. There's no real there's grandfathering in the sense that the old deductions are not going to be clawed into this rule, and the portion of NOLs in a foreign country like Luxembourg that is attributable to these hybrid deductions prior to 2018, those aren't going to be covered. So that's good. But after 2018, or for CFC years, certainly beginning after January 1, 2018, this rule kicks in, and so it's beneficial to eliminate these PECs and CPECs ASAP. One last point about that is that they have to be eliminated with care, because it depends very much on the terms of these instruments, and one false move and you could have a dividend in the recapitalization of these instruments. I mean, typically we're converting them into stock or converting them into capital, but it's very important. These instruments are not all the same. Different firms, different accounting firms, prefer different types of instruments, and we think that you have to do it with a great degree of care. So that's the message for today, and please, I'll hand it back over to Scott. Feel free to send us emails or questions about any of the above.
Thank you, Sam. Definitely a lot to digest. These slides are very good, and we're available for download. Will be available for download on our website, so you can pull these down, study them a bit. If you have questions, as Sam said, always feel free to email us. We're happy to address questions or think through any issues you might be facing. And we probably will circle back to some of these issues towards the end of the series when we cover the foreign tax credit and PTI rules and some other topics. Next week, we will be addressing opportunity zones and then following that up with state and local tax issues. We will circulate shortly an updated schedule for the webinars, so you should receive that this week. And thank you again to everyone for joining. We appreciate your participation, and I look forward to seeing you next week. Thank you.
Thank you. All right, bye-bye.
And that does conclude today's conference. We thank you for your participation.